Hi, good morning. This is a ledger in T-account form that represents displays all of the owner's equity accounts. The main equity account, Gronk Capital here, has the 27,000. That's been in the account all period long. It is not updated because we have been recording the items that affect capital in their own separate accounts, the temporary capital accounts. Specifically, the temporary accounts are the revenues, the expenses, and the withdrawals account. Revenue, R, E, expenses, D, the drawing account or withdrawals account. So a little cue or clue, what accounts need to be closed. Think of the color red and spell it, R-E-D, revenue, expense, and drawing. The idea is that 27,000 has to be brought up to date by the closing entry process because it hasn't taken up the revenues yet. It hasn't subtracted from the for the expenses, nor have we subtracted the withdrawals from it. So that this guy has got to get updated so we can begin a new accounting period with an updated capital account and amount, or an updated capital balance. Now, these accounts are temporary in the sense that they are accumulating the positive and negative transactions that will ultimately affect the capital account. So it's like playing an electronic game where you've accumulated, and at the end of the game you reset the values to zero, so that when we begin the new accounting period, we start off with zero balances in all the revenue, expense, and withdrawals accounts, so that we can begin a new ball game, so to speak. Okay? So what we're going to do, the purpose of the closing entries, is to clear out, bring the balances of the temporary accounts to zero so they can start a new period of activity. And in the process of clearing those accounts, we're going to update the capital account. If there's a net income, we're going to be adding to the capital account. If there's a net loss, we're going to be subtracting. So let's just go and do what they're asking us to do. So there's the chart of accounts, or the ledger I should say, and the instructions are journalize the closing entries. Well, obviously the entries need to be journalized and posted in order to achieve the goal of clearing out the temporary accounts. A credit balance is always closed with a debit. So if and it doesn't allow me to write in here, but if I entered a debit of 33,000 and then posted that debit would reduce that to zero. Now, typically what we do is we create this account called income summary and put a 33 in there. So I've got my my journal entry to close the revenue account to the income summary account. And what I did there is I checked the answer, and I'm ready to do the second closing entry. Now, if you can visualize, a debit there would bring that account to zero, and a credit there would set up a $33,000 credit in that account. But let's kill the expenses. What I need to do is transfer all of the expenses to the income summary account. And of course the dating is always the end of the period, July 31st in this case. So all the expense accounts have debit balances. So logic would tell us that in order to close or to bring a zero balance to that account, it would have to be credited. So for me to close the rent, the wages, the insurance, the depreciation, I would journalize and then post 45, 76, 33, 21, which would clear them out and put the total of them in the income summary account. So the insurance expense is going to be credited. That's $3,300. Or the rent could be first because it's listed first here. That's fine. It doesn't matter. But let me get all the credits in, and we can add them up. So it'd be $4,500 for the rent. And for the wages, it will be a credit of $7,600. And for the insurance, okay, so it appears then that we have the correct expenses credited, $45.76, $33 to insurance, and depreciation $21, and the debit would get posted into the income summary account. I can't write on this screen, unfortunately, but what I would do is post a $33,000 credit in the income summary account. Let's call it that. And then it's going to be larger than the expense because that's the revenue. And the expense total, which I'm going to subtract out in my calculator here, of $17,500. And of course the difference is going to be the net income, the excess of revenue, right? Fees earned, which would be in the summary account, minus the $17,500, and we'll show that as $15,500. Now just hold that number in your head because that's the net income that we have to transfer and add to the capital account. As you've seen, I'm sure, in the textbook, your PowerPoint, and other homework assignments. So anyway, let's just check the answer to make sure that we're good with that one. And okay, so we did a good job. Now it's my job to take that $15,500 that I just calculated and transfer it into the owner's equity account, into the capital account. So if there's a $15,500, it would be a credit balance in there. You got to visualize 33 minus 17,500 gives you the balance of 15,500, which would be on the credit side. We're going to transfer that to the capital. So you transfer by debiting that credit out and crediting it in to the capital account. I'll show you down here. So the income summary account would be debited for the $15,500, and the capital account would be credited for the same amount, the $15,500. And that takes care of the transfer of the profit or loss for the period. So that account would have 27 plus 15,500 in it right now if they allowed for posting in this particular exercise. The last thing I have to do is take this temporary account, the drawing account, which was accumulated in its own separate account, and we know that when the owner withdraws money from the business, it reduces his equity, it reduces his capital, but is separately accumulated in the withdrawals account. And now that the end of the period is here, we have to take that $2,500 out. That's a credit. That's going to be a debit into the drawer account. But let's just check, see if I'm good on that third entry, and the fourth and final entry would be to take that withdrawals account, again, keep the date. We're going to be debiting the capital account in order to reduce it. And the amount is $2,500. So when that 25 goes up there into the debit side of capital, it's going to bring that guy down, okay, by $2,500. And the final thing to do is to take the withdrawals account, and as if we're in the account, we would pop a $2,500 credit into the withdrawals account. So that's the bad debit, and now the credit wipes it out and transfers the bad guy up there into the negative side of owner's equity, so that the 15,500 would be transferred in as a plus, and the 2,500 would be transferred in as a minus after posting. I think we're done. Good job. And that's it.